Hey Rose, have you got the sound cranking? I'm just going to reshare. Cool. And we just can't see that slide. Whoop. Alrighty, so we're just going to get a bit of a countdown timer live while people come into the webinar this morning. Wonderful. So all working now? I think we need little DJ sets in the future, Rose. One of those embedded YouTube videos. Yeah. Welcome, Oksana, Raymond, Vic, and Afsana. Nice to have you here. Alrighty, good to see some other people joining us as well. Andrew, g'day. Guy, Jocelyn, Josh, Liz. We've got some regulars on here. Awesome. And we will get started in 17 seconds. Wonderful, thanks for that, Rose. And g'day everyone who's joined us so far. We are getting people joined by the second, so that is pretty cool to see. And welcome to our webinar, all about, I guess, upgrading the car, work utes, or equipment. So it's all around assets that you might purchase in your business and also structuring the finance on them. Before I introduce our amazing guest this morning, I am going to sort of just flag that we do have a couple of webinars coming up that might be of interest, and that might give a couple of people the chance to join if they're a minute or two late. But the two webinars I do want to share, firstly this one here. So this one's on the 30th of April. So that's, yeah, I think that's just next week, so it's a week away. And it's all about how to navigate 2021. I mean, we're already sort of 4 months into it, but David Dugan is a business coach. and he's got an interesting message around, what we need to be sort of keeping an eye on now that we're sort of coming out of the shock phase, and also focusing on how to grow and make the most out of the economic times that we're in. So that'll be really, really cool. I think, Rose, if you can just pop the link to register for that one in the chat box, that would be fantastic. And then the next one here we've got is actually in, I think it's the 12th of May. So the government's going to be releasing their federal budget update. Interestingly enough, that's when they ordinarily give us an update around the instant asset write-off, which is going to be a big focus of today's webinar. But there's usually a handful of other things that they announce, which are changes to tax. So we're going to be doing a budget update. It's going to focus on small business, self-managed super funds, and high net worth, sort of high income earners and investors. So that's the lens we're looking through on our update. And so if you do want to join us there, make sure you come along to that one as well. Wonderful. Well, again, today's going to be all about upgrading the car, work utes, or equipment, not necessarily limited to that. So you'll have the expertise of me, but also our lovely guest, Ashley Smith. So Ashley is the director of ASA Finance Group. He's a finalist in Asset Finance Broker of the Year, with over 18 years of experience. And in terms of finance, there's a vast amount of things you can do with finance. You can do property for residential or commercial or self-managed super fund or asset finance, and there's more than just that. But Ashley just focuses on that asset finance stuff. That's his specialty. He doesn't try to be, everything in the finance world, so he's really good at it. In fact, we've been really impressed with, the clients who've used Ashley that we've sent over to him, and it's just always raving feedback. So really, really cool. And
thanks, mate. Just very nice of you.
Yeah, it's consistent, mate. That's why we send them your way. And yeah, I mean, there's all sorts of other things like trucks, cars, earth moving excavators, heavy machinery, and more. So yeah, thank you very much, Ashley, for joining us this morning and sharing your expertise.
No worries at all, mate. Yeah, so very simply, I guess it's exactly that. It's what we'd say wheels and tracks and general equipment. If it's got bricks and mortar or dirt, that's not me.
Yep. What about a bit of dirt left on the excavator?
That's fine. We can do a high power compressor and a hose as well. If you need to spray that down, we can do all that. So that's fine.
Fantastic. That's great. And in terms of what we're going to cover today, actually, I'll start off with a bit. Sorry. Too many slides here. A bit around the instant asset write-off. So just a reminder, if you've been on our webinars before or seen this stuff, just a refresher on what that is. Otherwise, I will be sharing kind of the detail there as well on what can you write off from a tax perspective. How does that all work? So I'll start with that. We'll also, Ashley will then cover getting your approval and ordering your assets now and the important reason why to do that. And then also around the interest rates. So yeah, they're starting to rise, but we're going to get a bit more info on that towards the end. There will be time for Q&A, and this webinar, we should be sort of finished by about 11:30 if you're Brisbane, Sydney, Melbourne, joining us from the eastern states. So it is a bit of a quicker one than we would normally do, but we will have Q&A, and we can stay however long that each of us has to run through that. Alrighty. So let's kick off with a bit of the instant asset write-off. So for the business owners joining, when we look at purchasing things in our business, there's kind of two ways to treat them. The first one is if you're buying consumables where you might use them in the work that you do. Like, I mean, for accounting, it's a little bit tough. We might be consuming pens and stuff as we work, but let's say in the context of building a house, there's all that equipment. All the timber, all the steel, all that sort of stuff, tiles, all of that goes into building a property. So for a builder, they can instantly sort of claim that stuff as the cost of the goods sold, or in the case of paper and pens at Inspire, we claim that as expenses. So they're not assets that once they're used, they're gone, kind of thing. So that's one lens to look through. The other one is if you buy a piece of equipment, and we often call that an asset, that you're going to be using over a long time to sort of make money off in your business, then we can't write that off well, generally we can't write that off in a single year. In accounting land and tax land, we usually have to write that off over a number of years. But when COVID hit, they basically announced an interesting measure where it said that there's a temporary full expensing of any asset that you purchase, which I've never heard of in my working career. And it basically says if your turnover is under, I think it's $5 billion. Yes, it's 5 billion. So if your business turns over $5 billion or less, then you can claim the full cost of an asset up to 100% of its cost. Now, that includes things like, and I'll do an asterisk on cars, but cars, utes, equipment, machinery, printers, laptops, not necessarily the timber and steel I mentioned before that builds the house, but the equipment that you use to build the house. That's kind of where I'm going with this stuff. So there's no limit now on the amount you can spend. And that was eligible from the 6th of October 2020. So last October, when they announced this, through to currently 30th of June 2022. So we've got just over one full financial year to use this almost like concession, temporary full expensing. So it's pretty cool. Now, I did say before there is an asterisk there on cars. So you can't just buy a Lamborghini for $400,000 and claim the whole thing, even if it's sort of 90% business use. There is a rule around a depreciation limit on cars, and that sits around about the $59,000 mark. So if you've got a car that's primarily sort of primarily business use, but also primarily designed to carry passengers, then we can't claim the full amount if it is over that 59 grand. We've got to look at that depreciation limit. So what I recommend is if your purchase is not obvious whether it fits under that limit or not, just reach out to us or your accountant, and we can sort of give you some guidance on whether that is or not. So things like a single cab ute, that is obviously commercial. It's not designed primarily for carrying passengers, but carrying payload. So that's an example where, if you did have one of those huge Silverados or F-250s that did cost over 100 grand, something like that, then we can look to claim whatever business use percentage of it that asset is. So that's a bit around the instant asset write-off. I can cover more about it in the Q&A as well, but I do want to hand over to Ashley. So Ashley is going to kick off just as a reminder about getting your approval and ordering your assets now. So I'll hand over to you, Ashley, and run us through why we might need to do that.
Yeah, sure. So a couple of things going on in the market at the moment. I guess I'll start with what I do more specifically. So as a broker, I act as the intermediary between the client or the business owner and the financier. People generally use me because if you go direct to your bank, you may not always get the service that you might be expecting. If you're using somebody like a broker, I am a small business owner. It is my business. I'm the same as my clients. And the thing to keep in mind is I don't generate a salary. I have to close and settle deals to get paid. So I obviously have a vested interest in seeing your deal get done. I'm very keen to get it done as fast as I can get it done, and then I get paid, and then we can move on to the next one. So that's where I sort of sit in the process. Now, what we're seeing at the moment is times are increasing with our lenders. There was a small issue with COVID, well, not a small, rather large issue, where the financiers sent home all the staff. So where staff were typically in the office all day long working together, they're now working from home. So as a lot of businesses experience, it created issues around, systems, keeping an eye on people, motivating people, all of these, bringing teams together and all of these things. So what that created at the financiers, specifically in terms of a credit approval perspective, was times blew out. So there were instances where typically I would get an approval within 24 hours. Some of my lenders are now out to 3 weeks. Okay, so we're getting approvals depending on who we use. And I have 24 different lenders, depending on the client, what they need, age of asset, and individual circumstances. We tailor that for the client. So some deals I can get approved in 24 hours. Some deals I can get approved in 2 hours. We get stuff done as quick as 2 hours at the moment. Others can take several weeks. So they're the sort of things that we're seeing at the moment. What I'm saying to clients at the moment is we're seeing a huge uptick in demand. It's as big as we've seen in about 5-6 years. We're saying to clients now, the approvals are generally good for 90 days. If you want to get it this side of 30 June, granted we're only in April, get your approval now. It'll sit there until June, then you're good to go. We're strongly encouraging people, don't leave it to June to give us a ring, because we will probably get it done, but we can't promise that we can this year. So they're the sort of challenges and changes that are going on at the moment, which I guess takes us into the lead time. So if we look at it from, I guess, in terms of a move away from the approval, the asset themselves is taking longer. So there's two things happening in the market. Supply has fallen off a cliff. So as an example, Hiluxes and Land Cruisers and Ford Rangers, so obviously the three biggest cars we do, lead times on that is anywhere from 3 to 6 months.
Wow.
Yeah, it's not like the old days where you can roll into a dealership. Don't expect and don't wait for end of financial year sales this year. There will be none. You will see them advertised, but you will find dealers will not be negotiating because they don't care. They don't need to. It's not like the old days where you're threatened to walk. They're happy to see you go because the lead time is ridiculous. I mean, I heard of one excavator business actually shut the doors for a month because they had enough orders for the next 3 months where there was just no point staying open. They couldn't get enough gear.
Wow.
So I'm strongly encouraging people, get your approvals now, order your gear now, get it done early. Don't wait, you will miss out.
And just to add there, Ashley, to the audience, from a tax perspective, there is a technicality that even if you've ordered something, you can't technically claim it until it's installed and ready for use, or you've received delivery of it. When Ashley's organising the finance, let's say it's for a vehicle, he's going to do that settlement day when you get your keys to it. So I guess another way to sort of say is, if you don't receive it by 30 June, we can't claim it and write off the whatever you're entitled to this financial year. And that's why I kind of, when Ashley and I were talking a couple of weeks ago about this webinar, we said we can't leave it till May or June because this is relevant right now. In fact, it might already be too late if you're looking for the Hilux, the Land Cruiser, or the Ranger.
There's plenty of Amaroks and BT50s still out there, but there's not a lot else. So, and just on that, there seems to be, it's what we would call barbecue chat, where someone gives tax advice to another bloke over a couple of beers and burning a few snags. The reality is you cannot produce an invoice, and just because it is dated in that financial year, your accountant will accept that it is installed and ready for use. That will not fly. There seems to be a theory as we get down to the 20th of June, I get clients saying, "Oh, it's fine, mate. Just as long as I get the invoice for 30 June will be okay." No, not the case. We need to be settled. And there's a bit more to it than that. Hence why we end up pulling 18 hours a day in that last week of June, because everyone's needing to settle. But that is something to keep in mind. It's not date of invoice.
Yeah, very cool. All righty. Well, I guess the next topic now is on the interest rates. And when we caught up for lunch, you said that some interesting things are happening a few years away. You'd like to hear a bit more?
Yeah, so it's very interesting. Traditionally, I would say roughly, what do we think? 6, 7, 8 years, we've been in a declining rate market. Rates have been coming off. Great news. Everyone keeps being told to renegotiate their rates around home loans and all these other things. Now, the reality is rates are pretty much as low as they're ever going to go. This is where we're at. We saw an increase in rates for 25 basis points about 6 weeks ago. Now, the thing to remember with asset finance is they're fixed term, fixed contracts. So typical terms would be 3, 4, or 5 years. We don't write anything longer than 5 years. It's a poor outcome for the client, typically. So what's happening is, whilst the RBA is releasing data claiming to not be looking to hike rates again until 2024, it has to be kept in mind that if you take out an asset finance deal now with a view that it will end in 5 years from now, taking you through to 2026, the rate will not be the same for the financier. So what they need to do is they need to factor in essentially what they feel rates are. And without going into a full explanation around money markets and how banks acquire money and rates and all these things. But typically there's a yield curve, what we call at the back end. So 5, 10, 15, 20-year rates and bonds where banks trade money to each other, essentially. The yield curve, as we would call it, went what we call bid. So it increased. And it increased in the back end in the 5, 10, 15-year space purely because people know rates are going to increase. And it hiked prior to that period. So it started hiking in 2 and 3 year space. It hiked sooner than how do I explain it? So it went up sooner than what the RBA is claiming that rates will increase. So whilst the RBA is saying they think it will go up in 2024, the banks don't believe that to be true. We are all expecting rates to hike sooner than that. And the reason behind that is, forget about increasing house pricing. Let's leave that to one side. But we're talking about a rapid decrease in unemployment. We're seeing it accelerating faster than we expected. We're seeing GDP shoot up faster than expected. And the economy is looking in much better shape than what we first thought. I mean, obviously, tourism, retail, and hospitality are industries that are still struggling. They're still rebounding. But if we look at construction, infrastructure spending, and all these other areas, that is rebounding rapidly. And that, in turn, is creating positive market sentiment, which in turn is driving an increase in interest rates. So we expect the market to rebound faster, which in turn will dictate to the RBA it is now time to start increasing the cost of funds, which in turn will have an impact on your loan.
Yep. And so so right now it's just 0.25% that you've seen it go up.
We saw a quarter point rise about 6 weeks ago. That's correct. It's the first time we'd seen a rate rise in years. It was interesting because I have clients who I'm doing deals for every 2 or 3 weeks. They know rates, they know where things are at, and suddenly rates have hiked. They didn't believe me. I had to send them some market data and some other stuff around what was going on. They thought I was overcharging. The reality is rates are increasing. So I expect this to speed up. I don't expect half percentage point jumps. I do expect quarter percentage point jumps.
Yep.
I can't tell you when I expect the next one, but I do expect another one within at least 12 months. And you'll start seeing it in the home loan space too. Asset finance moves first. Home loans will follow.
Yep, there you go. And so if I was to buy a piece of equipment right now on a 5-year term, once it's locked in, it's locked in. They're fixed rate agreements that you organise. They're not variable.
Correct. Yeah, fixed rate, fixed term, fixed repayment. Reason behind that is it provides a lot of security for the client. When you're doing your annual budgeting, you want to know things are at. You don't want repayments on an excavator, a truck, or even a car moving. So they're fixed and done. That's stock standard for all the chattel mortgages we write. Most of the terms are between 4 and 5 years as well.
Yeah, okay, cool. So there's certainty around that, even if the rates do rise later. If you own the asset and sign that agreement now, it's essentially locked in. So no, that's handy. Wonderful. All righty. Well, did you have anything else to share on those points before we go to Q&A?
No, it's just very simply move fast. I don't mind. As I said, I get paid when the deal settles, but I have no problem for clients getting an approval early, giving them some assurances that they're good to go. And then once you're approved, go and find what you want. If we have to increase the approval, we're happy to do that. What I'm strongly encouraging people is do not wait till June. We will probably get you done in June. I'm not saying don't call me at all if you've missed the 1st of June. We'll still get deals done. There are still financiers that we have. We'll just have very limited options. But put the approval in place, get it all sorted, get some peace of mind and order your gear now. Don't wait. This is not going to be a situation where previous years where people can ring on the 15th of June and have an expectation they will get done. We've been able to do that previously. This is not the year for that. We need people moving quick. Otherwise, you will miss out.
Yeah, for sure. Okay. Thank you for that, Ashley. And I guess now it's over to the attendees. If you'd like to ask a question to Ashley with the finance side or me with the tax side, then please fire away. If you can, there's a box that says Q&A. That makes the questions easy to track, but please go ahead and pop them in. And before we get to answering those, because it might take a minute or two for people to pop questions in, I will do a reminder on the webinars. I shared these earlier, but we didn't have everyone joined. We do have a webinar next Friday, the 30th of April, and it's all around business growth and how to navigate 2021. We're 4 months into it, so I guess we need to get cracking if we haven't already on plans around growth. But I'm going to be joined by a business coach, David Dugan, and he's been mentoring business owners for over 15 years, and his clients achieve an average of 253% year-on-year net profit increase for for the past 6 years. So incredible results. He's my business coach as well, and he's fantastic for insight there. Cool. And then the next one we've got, which is on the 12th of May, so this is in a few weeks' time, is all around the federal budget. So the government are updating the federal budget on Tuesday night, the 11th of May. And literally the next day in the afternoon, Riz and I from our team will be running through what it means for business owners, people who run self-managed super funds, and also investors or high-income employees. So that's the lens we will share the update with. I can see a couple of questions coming through, which is cool. And just one reminder before we get into the Q&A, if you are a client working with us, fantastic. But if you do need a bit of help with this tax planning season and the lead up to 30 June, feel free to reach out for a strategy call with one of our accountants. And Rose is actually going to post the link to book in for a strategy call with our team. We can usually do same day or sometimes next day with the strategy calls, depending on availability of the accountants. But if you do need some accounting help, then please reach out to us for that initial phone call. There's no cost to it. If we can help, great. If not, then we might be able to find the right person who can help. Wonderful. All right. Well, Ashley, we're going to do a bit of Q&A if that is all good with you.
Sure.
And the first question is from Vic. Vic's asked, do you recommend chattel mortgage or a lease for equipment / finance, vehicle finance?
95% of the stuff I write is a chattel. Yeah, even more, probably about 98% of the stuff we do. Finance leases are a little outdated. It was more, I can't comment on the tax side of things. But just one thing that you'll notice with a finance lease is that with the GST on a chattel, you can claim back the GST immediately in your next BAS. With a finance lease, you're claiming back the GST every month over the term of the loan. That's not always a desirable outcome for some clients. Ben's going to be the best one to talk on that because my insurance doesn't cover me to give tax advice. But so that's the first thing. The other thing is with a finance lease, they're typically not something we do with the major lenders. The chattel mortgage, the cheapest rates, the best way we see to go is through a chattel. It's through a chattel, not a finance lease.
Awesome. I think the biggest sign there is high 90% is all you do is the chattel mortgage. Cool. All righty. Thank you, Ashley. Anonymous tax question. If I have only made a minimal profit in 21, can I delay the asset write-off to 2022 when my business is more profitable and there's more to write off? I guess in a way that depends. So it depends on when you purchase and receive that asset, because technically if you use the small business depreciation rules, you have to use them all. There is an exemption on having to basically claim. You've got the option whether you claim the remaining assets in your business pool, and this is like hectic tax thing right now I'm going into, but all your remaining assets before this huge write-off came into play, what we do is we'd write them off over a number of different years, and we'd claim 30% a year for the pool of your assets. Now, last financial year and this financial year, I'm pretty sure it's both of them, we were able to claim the whole lot if it was under a certain value. Now it's under an unlimited value. And what that means, you do have the option to write off the pool or not. And if you do have a low income year, it may not make sense to write off that pool. But back to your potentially original question is, if you buy new assets, you still should be depreciating them under the small business rules. And that might mean if you haven't bought the asset yet, maybe wait till next year to receive it. Okay, so I'm just, there's a couple of tax ones in here. I'm just trying to bounce it between you and me. All right, Justin, I've had a major franchise business for over 12 months and wanting to expand, but I've only been offered finance at 14 to 16% because the business hasn't been operating for more than 2 years. What other options are available, Ashley?
Okay, so that's more of a, I'm assuming you're trying to, so if you're buying equipment, we can do rates lower than that. We can do startups at those rates. I'm talking a startup going less than a month. At 6 months, if you've been going, depending on the equipment, keeping in mind I'm only doing gear. we can get you into a major after 6 months, depending on your financials. So there's disclaimers and asterisks, everything there on how it would look. But if you've been going 6 months and you're trying to buy some gear, yes, we're happy to look at that, and we can beat those rates. Those rates are typically for a cash flow lend. So I see rates between 15 and 20% for a straight unsecured overdraft. I've got a feeling that's what you might be referring to. That is, so you've got two options around that. That's industry standard for an unsecured loan. By unsecured, I mean they're not taking a direct lien over your property. If you wanted to get something cheaper via an overdraft and you owned a property, talk to a major lender. They'll certainly be able to help you out with that. That's not my world. It's more of a cash flow commercial finance space. But the gear we can do for a business going your time, and we can do it cheaper. Cash flow lend, that's sort of where it is without using property.
Cool. Awesome. Thank you for that, Ashley. Vic's asked a follow-up question on the Chattel. My concern with it is I get the immediate tax deduction now as well as the GST credit. That's fine. However, I will be required to make future repayments without any tax benefits whilst making more profits. Maybe that's not necessarily a finance question. That might be a sort of number stuff. And I guess, Vic, my recommendation to you is if you go down the Chattel model, then it's great that you've acknowledged that. That's the first thing that's awesome. And then what I'd encourage you to do is plan that out, whether you need to keep some of that tax benefit aside so that you can meet the repayments in the future, or put that GST credit, that amount you don't have to pay, keep that in a tax account separately, so that you can have it there as a bit of a buffer. But very good points, Vic.
So typically with a finance lease, there's a change in rules, Ben. I think, what is it, IFRS 14 or something, regarding on balance sheet, off balance sheet items. Traditionally, we did finance leases where businesses wanted to keep things off the balance sheet. Okay, so when you did it as a chattel goes on balance sheet, the business owns it, it's all theirs. Finance leases were typically, or they are, owned essentially by the financier. It's in their name, the invoice is made out to them. You make the repayments at the end of the term, you acquire the assets, ownership's transferred over. That type of stuff we see is through second tier lenders, where they want to keep their hands on the asset. They want to keep the asset in their name because the risk is obviously higher for the client. So when we're going through the majors in that regard, we generally don't do finance leases for that reason as well. Guys want that on balance sheet, but that's more of a tax related issue. And I know the rules did change around that about 18 months, 2 years ago. So maybe something worth exploring as well around that.
Yep. Okay. Cool. Well, I might fire another question at you. I'm just trying to pick the financing ones out. Okay. Do you do novated leases if it's more tax effective to put through my wife's employment arrangement?
Yeah. So novated leases are a funny one. Two types of novated leases is fully maintained, which involves maintenance, fuel, tyres, servicing, and non-maintained. The thing with a novated lease is that whilst it does have some tax benefits, when they're put up against a commercial chattel mortgage, the cost of the novated lease per month is generally far higher than the cost of a chattel mortgage per month. And we've actually run some analysis on this. When you take out the tax benefits that you get through the novated, it actually works out to be cheaper generally to go a straight chattel mortgage, because the cost of the novated is so high, the tax benefits don't cover the benefits against a chattel, if you know what I mean. So it actually works out better to go a chattel and forego some of that tax benefit because you're paying so much in repayment to actually get access to that. That is a broad answer. It's obviously a deal by deal basis, but that's what we've seen in regard to novated leases, most definitely. They're not something we encourage people to do, but it once again depends on your circumstances.
Yeah, and we I remember quite a few years ago, I did quite a few cash flow analysis, including the tax benefits, comparing the two. And I think there was like 1 out of 10 that was actually better on novated. So yeah, like from a net cost or saving, I've never seen them really a huge benefit. And
a lot of those tax loopholes are tightened. several years ago as well, and a lot of that has been stripped out, which is why now we're seeing the gap really close on that sort of stuff.
Yeah. Yep. No, there you go. Alrighty. Matt has asked, this one's for me. What sort of details should we store for 12 weeks in a logbook when you've purchased a vehicle? My recommendation is you use some sort of app to track it. Our app that we've got on the App Store actually has a logbook feature in it as well, but that can also track GPS and do that sort of kilometre tracking for you. What you need to do is sort of have a start date for your 12 weeks and just make sure you log your business trips and the kilometres associated with them versus your personal. And then what we look at is your business kilometres for the whole 12 weeks, divide that by your total kilometres in that 12 weeks. And there's our logbook percentage that we can claim of all your depreciation, GST, and expenses to run it. So actually Rose has just posted the link to our Apple and Android apps, depending on which way you swing there. And you can, there is a logbook little button in there that you can use to track those kilometres. And cool to see you've joined recently, Matt. Thanks for coming on board. And looking forward to working together. Another tax question. This is from Steve. What kind of dollar figure would be written off in one go on, say, a $50,000 vehicle? So what I might do, that's under the depreciation limit. I will assume that that's 100% business use, if that's all good. And if you're less than that, you can just times my figure by 90% or 80% or whatever your estimated logbook percentage is. But if we've got a $50,000 asset, and if it's got GST on it, we need to claim 1/11 of that in GST, which will be $4.5 grand ish, and that means we've got 45k left also to claim, and it's a deduction, so you don't get 45 grand back from the tax office, but you get your effective tax rate. So let's say your tax rate is it could be anything, but let's say it's 30%. That is 30% of 45k or 13.5 grand, and this is rounded. Just a reminder, if that's a 50k asset that you pay GST inclusive on, you get your 4.5k back in GST straight away, and then 13.5k in less tax that you will pay, assuming you're making a profit. So cool. That's pretty handy. Alrighty. Another question. So this is from Guy. I am a consultant and have just opened my own business. I own my own car currently, but would like a steer on the best options for a consultant from a loan and tax perspective. Guy, I'm just not 100% sure on the aspect there. Are you considering buying a new vehicle and just the challenge you might have as a fairly new business, or are you looking for some advice on just claiming the car in general from a tax perspective? Also, we are a few minutes over that 11:30 mark, so we might just keep going, and if you do have to leave, that is totally fine. Ashley's Guy has said yes, considering buying a new car. So Ashley, you did touch on a relatively new ABN or new business owner just before. Are there any guidance you've got on ability to do that? Is there any exemptions, or it's easier if you own property or anything like that, or is it just tough under 6 months?
Look, it is tough. It's not a space that, well, first of all, let's talk about this. The major banks won't touch it. Okay, so to manage people's expectations, you're going to struggle seeing a rate below, 5, 6, 7, 8%. Okay, I won't rattle off the statistics of businesses that fail in the first 12 months, but they're quite high, as we all know, right? So there's obviously an inherent risk associated with that. Major banks aren't too interested in touching that space. We do have lenders that will go there, and we'll do that. We're looking at rates around about 9.99 to get started. That depends on various issues. And I'm assuming this is a business going sub 6 months. Home ownership certainly helps. We're going to look at things like the bank statements, how much cash is going through the business. We know we can't get our hands on finalised financials for that year. And in some instances, some clients are still standing up zero and and their management accounts and things like that. We appreciate that. So those types of deals are assessed very quickly, very easily via bank statements. To answer that question.
Yeah, cool. All righty. So it is a bit tough, higher interest rates.
It's rate for risk. Think about it this way, rate for risk is what I would say is, if you've got a business going 15 years, you're obviously a different risk to a business going, 3 months.
Yep, fair enough. Cool. Alrighty, hope that helps, Guy. And yeah, claiming the car. I kind of, as I work through that 50K car example, if it is a chattel mortgage, then you can use that sort of guidance to work out how much you might be able to claim there. And then do keep in mind your running costs as well. So fuel, tyres, service, maintenance, all that sort of stuff, insurance, rego, all the fun stuff. But do keep that logbook as well, because that is the key to claiming the most when you're looking at claiming vehicles. Alrighty, anonymous. So this is a follow-up question from the novated lease, Ashley. Have you found novated leases to be more cost-effective for when someone is at a particular marginal tax rate and higher? So I might actually answer this one.
Yeah, I don't want to go there.
So I'm not sure what your name is, but anonymous. So the one novated lease that worked, I do remember that person was earning above $200,000, and is in that highest marginal tax bracket. So that was the one that. Or one of the ones that was actually better on a novated lease, but again, it wasn't life-changing amounts of money that it was better. So yeah, that's kind of the turning point where I was like, well, I don't know whether there's much of a major benefit in the novated lease side of things. But given you've got quite a few questions around it, I'd always recommend getting the cash flows done, like compare them side by side before you make that decision. Wonderful. Well, actually, we do have one more question. Liz has said, do secondhand cars need to be written off using the instant asset write-off and not the temporary full expense? Liz, you are correct on that technicality. So the temporary full expenses, the one with no limit, is on new assets, so new depreciating assets. If you do buy a secondhand car, you are limited to, I am fairly certain it's $150,000. So it's still a very high limit if it's a secondhand asset. Cool. Alrighty. And I think that is about it from the questions that have been asked. But thank you very much, Ashley, for sharing your knowledge with us. And yeah, I hope to the attendees that's been valuable for you.
Wonderful. Thanks, mate. Happy to help anytime.
Alrighty. Thanks, everyone. Thanks for joining, and I hope you can make one of our future webinars. Alrighty.